So you take those two pieces, the 100, 200 plus years of financial, consumer, and commercial credit experience and regulatory experience, and you combine that with just lightning fast data handling, data privacy, information management, and that group, when we're together, we can take any financial product and modernize it, cut the overhead and the cost of actually running that software by about 1/3, increase the security, increase the accessibility to new consumers and new markets. And it's really an all boats rise situation.
Good afternoon, Howard, and welcome to Accumulate's The Chain Reaction, which is the name of the podcast, which we came up with about 90 minutes ago, to be honest with you. But I love it, don't you? I mean,
I love it. Yeah, solid.
This is our premiere debut, maiden voyage with our first podcast for Accumulate. We're very excited about it. And, you know, as the team was talking about doing this, I said, let's do it as quickly as we can. They said, who do you want to have on? I said, let's have Howard from my buddy Howard from unFederalReserve. So Howard, welcome and thanks for being with us.
Hey, thanks for having me here. I'm really excited for you, Michael. I follow you personally on LinkedIn. I love, it's like with my morning coffee. I love to catch your insights. So I'm honored. Thank you for having me here.
Well, great to be with you. And let's just jump right in. I think the purpose of the podcast is to have fun, to be educational, informative, and lively, good, engaging debate. And obviously, we're talking about all things DeFi, dApps, DAOs, crypto, digital assets, because the world's changing, and we want to be a part of that. We want to kind of talk about that. I mean, as we get started, tell us a little bit about your background and what you did, for the bulk of your career and how that led you here. But I know a little bit about your background, but talk about what you did on Wall Street and the roles you served in. And I'm really interested in some of that stuff.
Yeah, great. Thanks for asking, Michael. It's funny because crypto and the blockchain industry is so new, everyone's got an origin story now, right? Like there's no, I don't know that there's anyone kind of dyed in the wool that got into crypto, right from jump. They've all kind of come from somewhere. And for me, my journey started on Wall Street right out of college, working for a small broker dealer, doing VC and angel deals. I was advised to go work for public companies out of this kind of smaller shop because public company experience was what everyone kind of needed to sort of move up the ranks in finance. From there, I went into banking, and for 10 years, I was in pricing and risk and valuation for consumer debt and commercial debt.
And were these like a tier one bank, as they call it, or smaller banks, or like regional banks, or where did you work?
I was blessed to go right from being in a public company to going to work for HSBC. They had just made some inroads in the U.S. And were kind of stacking up people that had experience in capital markets and finance and risk to make a splash in the U.S. So I was there at HSBC for a handful of years.
When would that have been? Around what years would that have been?
It was like pre-crisis. So like, but my career, if you look at it, I have been on like micro industrial Titanics. I got into VC right when the telecom bubble burst and everybody was making money there. I go into subprime lending at HSBC right before the housing crisis. But I'll tell you, with adversity comes experience, and it's only through seeing challenges of companies and industry that you really learn how to first off, you learn how living by a single truth makes everybody's life easier. You also learn that a lot of times bad news doesn't travel. And that you have to create environments where people are willing to discuss things that are challenging. From there, Wells Fargo. And then the last 10 years, I was in public accounting, advising all banks and financial services companies on the same stuff that I had experienced being in the banks themselves.
Tell me about what were you doing in 2007 and 2008.
It's I should have one of those lights hanging over my head. Like, where were you on the night of? I'll tell you, I was honestly helping the bank buy probably every second lien mortgage behind a consumer first, where there was no income, no job, no asset. Just really it was the high times. Everybody was buying commercial, consumer mortgages. And I was definitely part and parcel with helping the bank do that.
Yeah, I mean, to me, I look at, honestly, I think, in the, at least in the Christian faith, I'm not sure about others, but probably others as well, but you have before Christ, and then I think it's Amo Domini in the Latin after, I don't even know what it means, but like BC and AD. And obviously tied to when Jesus Christ was born. But in finance, I think like the seminal turning point was Lehman Brothers. And because there was a notion of trust and centralization. Maybe the trust wasn't there. Certainly the whether or not there was trust, there was a greater centralization. And there's still a tremendous amount of centralization today. But I think what happened was society globally looked at the risk allocations and said that doesn't make any sense. The banks are borrowing from the governments basically for next to nothing, and they're taking that risk, investing it for their own benefit. And then when there's a problem, it's back on society to sort of bail that out. And that fundamentally, I mean, it's amazing there weren't like real riots in the streets or sustained riots. But I think people have said, look, this is a fork in the road. This is a fork in the road, and we're going to go down another path. And then, of course, months later, Satoshi's white paper came out and started this whole sort of financial revolution. It's more, and I think it's more than financial. I think it's just a general revolution. It's a peaceful.
Yeah, in general, it's like the disaggregation of information.
Right. So tell me, let's just fast forward. So, and I want to hear about the work you're doing right before unFederal Reserve, but jump to like where you are today. Tell me about unFederal Reserve. What is it? What is unFederal Reserve? Why does it exist? How does it make money? Or maybe that's not even an objective of the protocol. I don't know. But just tell me about it like I'm a fifth grader, because that's about my level of intelligence.
Yeah, no worries. That's an interesting ask. There's some pretty smart fifth graders so that could probably describe it even more sophisticated than me. But on its base, we're a software company. So we're a software company with really deep qualifications in institutionalized traditional finance and cutting edge blockchain Web3 development. So you take those two pieces, the 100, 200 plus years of financial, consumer, and commercial credit experience and regulatory experience, and you combine that with just lightning fast data handling, data privacy, information management. And that group, when we're together, we can take any financial product and modernize it, cut the overhead and the cost of actually running that software by about a third, increase the security, increase the accessibility to new consumers and new markets. And it's really an all boats rise situation. We're making the process less expensive.
Yeah. I got $100,000. I want to do something with it. I say, you've got yield or something. I give you the $100,000. What happens?
Well, first off, I'd love you to give me $100,000.
I would too. That would be great.
We are, we're a software company, not a bank, right? So in essence, everybody, you wouldn't give me $100,000. You'd come to the table with your $100,000 and hook up to our pipes. And you could do that through, you could acquire our token, ERSDL, to access our lending and borrowing platform, where it's a peer-to-peer lending and borrowing platform that's very fluid, highly secure, tens of millions, if not billions of dollars through the pipes on a cumulative basis at this point. and you had $100,000, I would say go turn it into 100,000 in USDC, DAI, or USDT. Those are stable coin representations of dollars. Put them on our platform, earn 20%, and set it and forget it, and you're good to go.
Now,
that's the first thing I tell you.
Now, you just said 20%. I call bullshit, and I don't know if we can swear on our podcast. Maybe the FCC will come in and pull that. But how in the world can you offer a 20% yield? I don't get it. Like, what is backing that trade? What is
sure?
Walk me. I mean, and I know it probably could take a 90-minute answer, but like, how
I can make it simple. I can break it down.
20% when the Fed's paying, 175 basis points on a 10-year. Like, how do you have more money than the Fed? I don't get it. How do you?
Well, in a peer-to-peer network, your borrowers fund your lenders. You basically, the system, and this is true for all DeFi platforms, Aave, Compound, Cream, you name it. In all these DeFi platforms, the rate the borrower pays is set. It's a mathematical formula that comes up with this is what the borrowers have to pay. And the neat thing is that all the borrowers are borrowing over collateralized. So if they want to borrow 50 cents, they got to put up $1 worth of stuff as collateral. The reason why our borrowers, well, to your point, is why am I paying 20%? The platform pays lenders 20% because our borrowers are paying 35%. So then your question should be, why would a borrower pay 35% when they can just go into Wells Fargo, take out a personal loan, and pay 8% and call it a day? Well, there is a switching cost for that person to go into the real world, go to the bank, what we call docs themselves, meaning fill out applications, qualify for that money, then take that cash, turn it into crypto, and then go and buy these fun altcoins and go gamble and play in margin, which is really what a large portion of our borrowers are using.
Basically, what it boils down to is, I mean, it's like anything in finance. Why would you borrow at 35%? Well, because you think you can return more than 35%.
And they're doing it.
And that's fine. I mean,
that's what they're doing.
And then wait, you guys get the VIG, or I know that's probably not a good word to use in this context, but the spread between 35 and 20 cents, is that collected by unFederalReserve?
So it's fully disclosed to the folks that go to the website, but we take what's called the reserve factor. So if our borrowers are paying 30%, we take about, I want to say 5 or 6%, and that goes into a reserve. The 30 minus the 5, now call it 25, gets then split up amongst the suppliers. And so what happens is,
Are you one of them, and there's other?
Yeah, there's this proportion. So our company does earn a portion of the spread, and then we use that to actually purchase our token out of the market. And there's a whole bunch of token economics to consiber.
Two things to say. I saw this quote today, and then recently, I'd never seen it before, and it's an amazing quote. And Albert Einstein. Compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it.
Ooh, yes. Well, you know what's interesting about it? I believe if there's a paper, this is a little bit above the 5th grade, but there's two economists, Hull and White, Nobel Prize winning, that wrote a paper called The Risk Neutral Probability of Default. And they basically broke down that all interest rates are a combination of ability and willingness to pay and likelihood of recovery over a given time period. So every single rate that we encounter in our lives is essentially the lender guessing what your ability and willingness to pay is. And if one of those two things fail, what are they going to get back over a given period of time? And when there's a mismatch, like you said, the Fed's paying 1%, we're paying 20%. It really speaks to the perception of the risk on that saving and lending. And because of the market being so inefficient right now, so much cash coming in, so kind of few and growing users, there's just a mismatch in that money. And Michael, that's going to work itself out. Believe me, 10 years from now, you're not going to have a situation where a bank is lending and borrowing at 8, and 4%, and then you're going to go to this whole other universe using the same currency and see rates in the 20s and 30s. It is just right now it's just a mismatch, and that diffusion hasn't taken place. What unFederal Reserve is going to do is going to help the institutions get to where they can pay and borrow at the rates that the cryptoverse will be lending and borrowing at also.
Well, these structural, I'm sort of fascinated by how you set up risk, and I know risk is like your background, but
yeah,
then the Wall Street TBTF model, too big to fail, as everyone knows, it was borrow as much as you can from the banks, risk other people's money, and then if it blows up, then then you say, well, okay, well we'll just defer to the Fed, right? Or like what happened with long-term capital management.
Remember those guys? Yeah.
Yeah, that was, I forget what year that was. I have to check the history books, but in that model there was a big problem. Long-term capital management blew up, and the Fed said to the banks, "You're going to solve this. You're all going to put a pro rata share in." Bear Stearns said, "No, we're not. It's not our problem."
That's right. Well, it's funny about long-term capital management is the guys that founded it, I think it was Black and Scholes, right? The Black-Scholes model. They even said, don't use our model to value options because it's a theoretical model, and everyone ignored them. They ignored the maker of the formula, and they built a whole industry around the formula that they told people to ignore, and it's still used today.
Right.
So it's pretty interesting, like how things get adopted that aren't always the most efficient. That it's not just the idea, but it's the idea and the time. And so that we're in a very interesting era now where people have adopted crypto and they've adopted these crypto rails. And not for nothing, the thing that will destroy crypto is already being ideated, and that is quantum computing. What no one really talks about is that the only way to corrupt a decentralized node product is by having computing power that exceeds or approaches the speed of light. Well, we're developing the technology in real time to do that. So the question is there a life expectancy on crypto that no one's even talking about yet because everyone's still excited and enamored and running straight forward into it?
I mean, I know we're not, we're both sort of familiar with regulations. We're not here to promote or, anything, but what do you make of what do you make of the rally in cryptocurrencies since the pandemic? Just if you go back to whatever that date was, March 10th, 2020, stocks, over the next course of the weeks sold off 35% or something like that, maybe 32%. Yeah. From that point forward to where we are today, what happened? I think Bitcoin sold off to briefly to like under 10 grand.
That's right. It was like $5,000-6,000.
That might have been like a little bit of a flash crash, but what in the world is going on? I mean, we've had this, and not just in equities, but just in crypto, this meteoric rise. How do you explain that? I mean, as an observer.
I was going to say, right, if this is just like two guys talking over a beer, like, hey, what do you think happened? Yeah. There's obviously a lot of extenuating circumstances, but I will say that, attrition, which is like the runoff of something, is really usually measured as kind of, or even growth. So like growth is the opposite of attrition. What we see as growth is typically a net number, people leaving versus people coming in. Given the way the small percentage of people that are actually in crypto and the rate at which adoption is happening, it's viral in and of itself. You have definitely, 1,000, 10,000 times the people entering the ecosystem that are leaving. So right off the bat, you just mathematically are creating demand pressure by having so many more entrants than exits. That's one. Second, you're working from home. You're on your company's laptop. Maybe you never had a company laptop. You were always using your home computer. You have the opportunity to explore and ideate where you don't have to worry about someone walking by your cube and looking over your shoulder and see that you have a Chrome MetaMask installed, right? The pandemic, for affluent Americans at least, I can't speak about other countries and what have you, the pandemic for affluent Americans really brought with it an incredible amount of freedom. And not for nothing, extra cash that wasn't being used. I know when I got a check, I got a check for having a couple of kids and being a victim of the pandemic. You know, that was automatically thrown around money. That wasn't me. I didn't need that to pay the mortgage. I had a good job. So like, to me, at this point, the government's giving me scratch off money. What am I going to do with it? Am I going to go scratch off? No, I'm going to go and put it in my Coinbase wallet, go buy Bitcoin. And then, you know, my buddies show me how to set up a MetaMask wallet and then all this and that. The reality is, I think the spare time, the excess capital, just natural organic growth has put an incredible amount of demand pressure. And it ripples down. So you'll see like this big entry into Bitcoin, right? So everyone buys Bitcoin and Ethereum, the blue chips. Then they make their money. And so what do? Then they sell off a little bit, and then they go and they buy the alternatives. But the alternatives they buy might be like a Link or a Solana or a Doge or a SHIB, right? Like they go into that second tier, and then they make a little money there and they sell off. And so you see this sort of like every peak in the blue chips eventually comes with a pullback and a redistribution into the alts. And that's going to be for the next 5 years.
I saw that movie in 2018, and that was the death of alts, at least for that year. It was just insanity. I mean, I've never seen a bear market like that one ever. I mean, Bitcoin ripped up to 20,000 and started to come down, and it basically sold off for 11 months without like any material upticks. And the altcoin destruction was just uniform. I mean, some of them exist, survive, but
how deep was the market? At the end of the day, market depth is a big part of it. And look at it now, the bear market for alts has been, starting in May with some proclamations out of China, the rise of NFTs, where people are like, hey, I don't want to be in, I don't want to be in a project for project's sake. I want to be in something that's going to appreciate 10 times. So I'm going to move to NFTs. Now you have the ohms and the times and the yield farming opportunities. It's like you have different personas, that are engaging in the platform at different spots with different goals in mind. And so it's getting to be clouded almost like the small cap equity market is, to try to understand why does a token perform, say, the way it does perform.
Yeah. All right. Speed round. Running out of time. All right. Three separate topics. Where did you come up with unFederal Reserve? And I know you love the Fed deep down, but come on, give me context on that.
I do. And in fact, unFederal Reserve is not deFederal Reserve. We believe in centralized banking serving a purpose. What we are doing is we're serving the entities that don't get served by the Federal Reserve. So there's 30,000 non-bank lenders. There's 4,000 small banks. They don't access the Fed window. They go to the Big 10, and the Big 10 deals with the Fed. We're serving those entities that aren't served by the Federal Reserve. Got it?
I got it.
We came up with it at night. It was we needed a name. Someone had showed me an unbanked article. I'm like, well, we're dealing with institutions, so call it unFederal Reserve.
All right, this is true speed round. We're just gonna skip hockey because I'm not a hockey fan. Jets or Giants?
Giants.
Yankees, Mets.
Mets.
Brooklyn Nets, New York Knicks.
Don't watch basketball.
I think I lived in New York for 2 years, and I would go Yankees, Giants, Knicks, no hockey. Okay. What are you doing for Thanksgiving, and what's your favorite side for Thanksgiving? Last question.
Going to my wife's cousins. It's like a Dominican Thanksgiving, so it's a lot of rice and turkey.
Oh, wow.
My favorite side is the sweet potatoes with the marshmallows and the pecans. The dessert that's a side dish.
Fabulous. All right. Well, listen, man, this was so much fun. You and I could sit here for hours. Of course, there'd be no one on the podcast listening, but you and I'd be going back and forth. So
I want to hear two guys talking. Michael, thanks for having me. Best of luck. Everybody at home, put this on your reminder list. Michael is just a source of truth in so many fields. Thank you
so much, brother. You're the best. Talk to you soon. Happy Thanksgiving to you.
You too. So long.